Okay, it's just gone 9:30. I'm excited to say that we are now live. Good morning, everybody. We'd like to wish you all a very warm welcome on this first day of UK SIF's Good Money Week. Thanks, everybody, for joining us. The title of our session today is Sustainability, Meeting Client Requirements. So we all know that sustainability expectations are rising fast. And with that in mind, today's session is about giving you clear, practical insights to help you stay ahead, meet client needs, and future-proof your advice. I'm Ellie Dowding. I'm Director and Technical Compliance and Sustainability Specialist at ESG Accord and the Accord Initiative. To deliver our session aims, I'm super excited to be joined by a range of amazing speakers and highly knowledgeable. They are highly knowledgeable speakers. So we have Louisa Chenda, who is a technical specialist for sustainable finance policy at the FCA. We have Sophie Meatyard, who is the ESG Funds Research Director at Main Street Partners. We have Frank Potacek, who is Managing Director at Greengage. And of course, we also have Lee Coates OBE, who is my co-director here at ESG Accord. So for those of you not familiar with our work at ESG Accord, a very quick intro. ESG Accord is a compliance firm specialising in sustainability and values. We offer consumer duty and SDR consultancy for fund managers and DFMs, as well as CPD courses via the Accord Academy, deep dive databases, an advisor's suitability toolkit, and our Accord Talks podcast, all of which I'm happy to say are freely available via the Accord Initiative website. So before we get started, I need a quick housekeeping note. So today's session is being recorded, and I'll share the link afterwards. And if you've got any questions during the webinar, please drop them in the Q&A box. Time allowing, we'll aim to cover those after the group discussion. So our agenda, I'm loving this. We're going to be quick-paced, keeping everyone on their toes and information packed. We'll start with the FCA comment from Louisa. Louisa will cover what the SDR rules do and don't mean for advisors and what requirements advisors need to comply with. Then we'll move to our individual speaker sessions from Sophie, Frank and Lee. And following this, we'll have some group questions and then time allowing questions from yourselves as the attendees. So diving straight in. We are starting with Louisa Chenda, Technical Specialist for Sustainable Finance Policy at the FCA. Lee, can you now share the video for us, please?
Thank you, Ellie. It is a pleasure to be speaking to you at this important time for the sustainable investment market. We now have a sustainability disclosure requirements, or SDR, and labelling regime in effect, which has raised the bar for UK domiciled funds. This means the information you'll be seeing on sustainable investment funds is clearer, more transparent and more retail friendly. And you'll of course have noticed some labels on certain funds too. There are around 150 funds using labels now, and many other funds have changed their name. But what does this really all mean for financial advisors? What doesn't it mean? And what requirements do you now need to comply with? I will give you a very brief overview. So the SDR regime is aimed at consumers, more specifically retail investors. We ultimately want them to be able to trust the sustainable investment market and the claims that firms are making. But the measures we introduce for consumers will also help you as advisors. They should help you to navigate the market. They should give you standardised information to support your recommendations to clients. And they should minimise greenwashing and give you confidence in the claims that firms are making. We introduced a package of measures to deliver these outcomes. This includes a labelling regime, naming marketing rules and disclosure requirements, and of course an anti-greenwashing rule that applies to all FCA authorised firms making sustainability claims about products and services. There is often a lot of focus on the labels, so I really do want to take the opportunity to reinforce that it is not all about labels. It's the overall package that together will deliver the intended outcomes. So, first thing to note about labels is they are voluntary. They must, however, be used if a firm chooses to use the term sustainable, sustainability, or impact in a fund name. And if a firm does choose to label its fund, it will need to meet qualifying criteria in order to do so. The second thing to note about labels is they are only for funds that have a specific sustainability goal aiming to achieve positive environmental and or social outcomes. In other words, they must have a specific sustainability element to their investment objective. So, labelled funds are only for certain clients with particular types of sustainability needs and preferences. But of course, clients might want to invest in a fund with sustainability characteristics that does not have a specific sustainability goal. So they might want to invest in an ESG screened fund or ESG tilted fund. And these products are just as important as labelled products. Consumers must be able to access these products and trust their sustainability claims too. So that's why we place certain requirements on these funds. For example, they must be accompanied by the same types of disclosure as a labelled fund so that consumers and you can see consistent types of information on both the labelled and non-labelled funds to make better informed decisions. And this really is where you play an important role. We recognise the key part you play in communicating sustainability information to retail investors. So we place certain requirements on you to support the aims of the regime. You should be familiar with these by now, but just to recap, you're now required to communicate the labels and consumer-facing disclosures to retail investors, and that's both for the labelled and the non-labelled funds with sustainability characteristics. You are required to ensure that these are kept up to date, so that's in accordance with any changes that the firm makes. And you're also required to provide a notice on overseas funds, those that are used in sustainability terms, to clarify that those funds are not subject to the UK regime. What the new requirements for advisors don't do is substitute any of the current rules or good practices, including around suitability and due diligence. So where clients have sustainability preferences, you as advisors must still take into account all information on risk appetite and investment objectives to recommend a suitable product for the client. What the SDR regime will do is help you as advisors and your clients to navigate the sustainable investment landscape more easily, and that's by raising the bar and providing clearer information. But the labels and the consumer-facing disclosures do not replace due diligence requirements. They're still important, and you would still need to carry them out in the same way that you would any other product. And taking into account everything that I've just mentioned, the most suitable product might not be a labelled fund. It might nevertheless be a fund with sustainability characteristics that is the most suitable for your clients' needs and preferences. I think just lastly, I'll recognise that this is a complex landscape and some of the advice sector would welcome more information and help on sustainable finance. So you may be aware that we established an industry-led working group where industry is working together to help the sector build on its existing capabilities, and that's including around our SDR and labelling regime. So let me take the opportunity to thank everyone involved in that group, including ESG Accord, of course, and we look forward to seeing the output soon. In the meantime, very much looking forward to hearing from the other panellists. Thank you.
Okay, thanks so much to Louisa for providing us with this really helpful context to get us started. I think many advisors do absolutely welcome the consistency that SDR brings, but as Louisa highlights for us today, it absolutely does not replace the core responsibility of due diligence. So I think that what we're seeing now is a shift in how firms integrate these rules into everyday practice. And it's crucial for us to understand not just the framework, but how all this needs to work in reality. So that takes us very neatly to our next speaker, Sophie. Thanks so much to Sophie for joining us. Good morning to you. Excited to have you here with us. So I know that you and the team at Main Street Partners have all been super busy producing some amazing research for the industry. I'm really keen to dig a bit deeper for our viewers today and find out about the key findings in your research on the implementation of the SDR and other ESG and sustainability related regulations. So over to you, Sophie.
Thanks, Ellie. Hi, everyone. I'm Sophie. It's great to be here. To provide some background on Main Street Partners, so we provide ESG and sustainability data. We cover corporates, GSS bonds, basically anything ESG and sustainable that you can think of. So PAI data, controversies, etc. I myself work in the fund research team, so we use a lot of that data as part of our rating. We have a 1 to 5 rating. So we look at 3 different pillars: the asset manager, the strategy, and then we do a holdings analysis. So we think our 3-pillar approach kind of is more forward looking because we're looking at what the strategy is trying to actually achieve rather than just doing a holdings analysis. So this allows us to look at a more holistic view rather than just sort of what the aggregate of the underlying exposure is. Our ratings are absolute, so not relative to peer groups or benchmarks, which aligns really well with the FCA's SDR, which obviously takes a more absolute approach rather than relative. In our rating, a score of 3 or above is deemed to be ESG assessed, while a 4 and above is sustainability assessed. This distinction aligns well again to SDR, as we distinguish between ESG integration as kind of at its most basic risk management and then sustainability positive outcomes. So we're quite happy with the regulation, as you can imagine, considering that it aligns quite well. So we've welcomed it, and we think overall it's been a really positive experience, while we recognise obviously it's been quite challenging for some asset managers to go through quite a lengthy process sometimes to make sure that they're speaking about sustainability in a way that is understandable to the end client. Particularly the focus on greenwashing. So this in our ESG and sustainability barometer, which is an annual report that we do, which is a whole kind of assessment on our 10,000 fund strategies that we cover. And we found that nearly a quarter of the Article 8 strategies that we were covering were presenting with some risk of greenwashing, i.e. they had a rating lower than 3, which is our ESG assess level. It's a pretty significant number and underscores the importance of that robust, thorough, independent research alongside regulatory scrutiny. On the sustainability side, only 4% of our 10,000 strategies that we cover meet our sustainability standard, sustainability assessed sort of level, which is that 4 and above. So we weren't really surprised by the relatively low number of the kind of that initial wave of fund through, or by the number of name changes. It's been quite difficult though to kind of pull apart that name change data basically because of the fact that we had the ESMA naming guidelines come out at the same time or kind of take effect over the same period. So it's meant kind of there's been a lot of name changes, definitely for the better. And in some instances, it's just so much clearer now to be able to see what a fund is trying to achieve through the name. So for example, a lot of the strategies that maybe were applying exclusions only are now called screened rather than sort of ESG plus sustainability plus this. So I think that overall has been a really positive outcome. And we've definitely started to see that in the data that we're looking at. I'd also highlight that within our rating, the funds that we've seen come through with the SDR labels have all been rated kind of 4 and above. There's been a few that maybe are on the cusp where they haven't talked about sustainability as clearly when we did the review of that fund, but as we do the next review, we expect that some of that clarity around the language being used will potentially improve the ratings of those funds. But for example, all of the impact funds, we found the average was around 4.6 on our 1 to 5, focus strategies around 4.1, and improvers around that 4 mark as well. So we think this highlights the effectiveness of the regulation in pulling out the funds that really are trying to target sustainable outcomes, rather than those that maybe are just sort of ESG integrated or doing something a little bit more beyond that, but it's not a sole focus of the strategy. The findings of this SDR, kind of the work that we've done on SDR, can be found in the SDR section of our barometer, which we're starting again kind of at this point in time for next year's release, as we start to look again at our whole universe of funds. So we're hoping that we'll have a lot more information around kind of the implementation of SDR as we look back now. That's probably me done.
Yeah, the document is really very good. So yeah, thank you for all the work that you're doing. And I'm sure that I'm not the only one in thinking that well, there's some really valuable takeaways, and we will pick up on some of these points again as we move through. Okay, so let's keep moving. We'll move to our next speaker now. Next up to share, we've got Lee. Lee is my co-director of ESG Accord, and I have to drop this in. Lee is also the recent winner of Investment Week's Outstanding Contribution to the Sustainable Investment Industry. Good morning and happy Good Money Week to you, Lee.
And a very good money week to you too.
I know. So I'm looking forward to your comments today, Lee. The subject is obviously close to our hearts at the Accord Initiative, and I think that this topic cuts straight to the point where we know that firms do have a lot of questions. So what are the challenges when it comes to educating clients about sustainability and conducting product suitability assessments?
Well, okay. I think I'm going to break it down into 4 areas. And the first one is identifying clients, because they don't self-identify. They don't run around going, "Oh, look at me, I'm a sustainable investor." So I'm going to start with an analogy. Let's picture a classroom with students all desperate to learn from their teacher, but they don't know what they don't know, so they can't ask anything. They're just waiting for the teacher to start. And the teacher decides that because of the way the students look or sound, or based on where that they've come from, that they're only going to get a limited education. So I could tell you this, but I'm only going to tell you that. None of that would be comfortable for any of us that have got kids, and wouldn't want that from a teacher. And the advisor-client relationship is really no different at all. Clients need their advisor to deliver good outcomes based on an understanding of their needs. But they don't know what an advisor needs to know, so that they can only wait to be asked by the advisor about any preferences. So for advisors, they really need to make sure that they ask every client, because as I said before, clients don't self-identify as being sustainable. But in asking, they have to remain neutral. So there's none of that, do you wish to invest sustainably, or can we talk about serious investment? That wouldn't be exactly neutral. Neither would, are you happy with your investment killing babies? That might be construed as leading the client. So neutrality is absolutely key for advisors. And they need to provide information to the client about the different investment pathways. And by that, I don't mean that they have to go into great detail about equities, bonds, derivatives, and all that. I just mean generic investment styles, such as explaining conventional investment, and then conventional investment where it's using ESG for risk, sustainable investment, and values-based. And obviously talking about sustainable gives the opportunity to talk about the labels and the equally relevant non-labeled options. So basically let the client decide how they would like their money invested, and then the advisor's job is to deliver the best outcome. So that's the first one. Second one is basic, really, meeting consumer duties, informed choice. I'll use another example for this one. So let's assume a client loses money on an investment which has been recommended by their advisor. Now, the file notes are really good. Attitude to risk, capacity for loss are really well documented. Due diligence is completely referenced, all stacked up, all detailed on file. And the suitability letter is an absolute work of art. So everything is absolutely perfect. Now, given that performance on its own isn't generally a basis for complaint, especially if the client's gone through the attitude to risk, so they know market-based investments can go up as well as down. So what can the client do? Well, they could simply say that they would have invested differently, for example, in ESG or sustainable, if they'd been offered the choice. And in this case, it looks like the advisor decided against these options for them, and therefore the client wasn't able to make an informed choice. So Consumer Duty requires that evidence of informed choice. If a lot of information, a lot of important information, and I don't mean bonds and equities, all that sort of stuff, but the different pathways a client can follow are not documented and not explained to the client, then it's impossible to prove that there's been an informed choice. Now, that information really should go out before the meeting to give client a chance to review information. And then at the meeting, all the advisor needs to do is say to the client, you know, did you receive the information? Did you read it? Did you understand it? Are there any questions? If there are any questions, the advisor answers them and documents that on file. I'm going to keep repeating, document it on file. And basically now you'll be able to get confirmation of clients. So do you feel comfortable now you're making an informed choice? So it's the client, you're getting a declaration from the client that they feel comfortable making an informed choice. So all of this so far, I've described it in a way that's protecting the firm against the complaint. But if you flip that on its head, the other beneficiary in the process is the client, because they're going to feel more engaged. They feel like they're getting personal advice, and they're going to end up with outcomes that are good for them. So it's a win-win for everyone, except maybe claims management companies. So the third area is the actual due diligence, how the firm actually provides its investment advice. So inevitably, if you ask questions, some clients are going to say yes to wanting sustainable options, and there's going to be inevitably an increase in the due diligence, and that's just basically one of the lots of the life of an advisor. But how much extra, it depends on the way the firm generally provides the investment advice. So if the firm picks individual funds, then clearly the work is going to be significantly more, because the advisor is going to have to look at, what did Louisa say, 150 labelled funds? So there's 150 labelled plus twice that number, I believe, that are sustainability characteristics. So if the firm is providing fund-based advice, buy this fund, buy that fund, or invest in that fund, then they're going to have to do the same due diligence or demonstrate that the due diligence has been done on the sustainable options or values-based options. That adds another dimension. And in that case, then something like Green Gauge, Frank will talk about it later, something where you can go to get the information in one place is obviously going to save time. If the firm has its own CIP, conventionally invested CIP, then depending on how many clients they have that say, yes, I want sustainable, it may not be economic for the firm to actually run a sustainable CIP, because which sustainable CIP do they run? Is it label based, in which case, well, there's 4 labels, so there's 4 CIPs. It might be better that they maintain their conventional CIP if it's for the majority of their clients, and then use something like an MPS multi-asset. And then the third option is, if the firm is already using MPS and multi-asset for most of its investment solutions, all they need to do is find a sustainable and values-based solution that's meeting the average client needs. So the amount of work involved is really down to the way the firm works. And then finally, if you bring all that together, you've got a suitability letter. And I'm going to go back to the school analogy here, but this time we're all going to go to the home economics class. Okay, so if you had a student and you judged the quality of their output, their cooking, but as a teacher you only gave them half the ingredients, you might think it's slightly unfair to mark them down. And the FCA look at advisors and the advice process in much the same way. So for an advisor to demonstrate that they have delivered good outcomes in the suitability letter, the advisor will need to reference all of the ingredients to show that they know their client, the client has preferences and objectives, and the preferences are based on an informed choice. So you put all that together, that's everything. That then goes obviously through the due diligence process, and then all of that is summarized. The output is a suitability letter. And if you do all that, keeping with the theme, then let's call it the suitability souffle is going to rise. But if you don't have it, it'll be a nasty goo on the bottom of the oven. There you go. I'll leave you there.
Thanks for that, Lee. I'm loving those school examples. That's really great. And I knew you'd enjoy that topic. So next up, we're keeping things swift moving for everyone. So next up, let's hear from Frank from Green Gauge. Thank you so much to Frank, and good morning to you. I'm excited to hear your thoughts. And I've got a small personal admission here. I love hearing from you, Frank, because of the depth and breadth of technical industry expertise that you have. So I'm sure this question is going to be perfect. So we know from the FCA research that consumers find it difficult to identify products that that need to meet their sustainability preferences. So that's not helped by lack of standardized accessible information and the use of possibly unclear or confusing terms. So in your experience, and with the work that you're doing at Greengage now, how are advisors managing to access data to understand product providers' sustainability propositions? Over to you.
Thank you very much, Ellie. Good morning, everybody, and thank you very much for the invitation for being here. Yes, it's a tricky one, isn't it? We have consumer duty, which is front and center in the lives of any advisors, and yet they take information from, predominantly in this case, from fund managers. And we heard from Louisa earlier on saying SDR is effectively from funds. So it's the manufacturers creating all this wonderful stuff, feeding through the chain, all the way to the advisor and then the end consumer, rather than actually starting at the consumer, the retail investors, as the FCA calls them, and saying, okay, fine, what they need. And then the advisor actually sort of saying, okay, fine, what information do I need to be able to provide that suitability that Lee basically sort of talked about earlier on. So by and large, most advisors are getting their information on sustainability from the consumer-facing disclosures of those funds that have decided, because it's a voluntary standard, as the FCA said, to be able to produce that. And if you think about sort of the scenario, you know, you're an advisor, you're meeting with your client either via sort of online or face-to-face, and you go through the KYC, you know your customer, and you're asking, you know, do you have any ethical or political, geopolitical issues? Do you want your money to take into account, your investments to take account of that? And if the client says yes, then what? And that's the big challenge that advisors have, is getting from the client discovery phase to the research and then to the sustainability, the suitability of sustainability. Most of the systems, so if you're using sort of special software, most of that software starts from the language of the manufacturer, from the investment manager, from the regulators, from the NGOs, and et cetera. And this is where, you know, people like Greengage, we try and bring all that complexity together, try and explain it, and make sure we translate all these standards into terminology that the client actually sort of understands. The other thing as well is when you actually look at the CFDs, the consumer-facing disclosures for sustainable investment funds, then they basically use the language that the regulator gave the industry. It comes from the source book. It comes from the policy sort of statement, and then industry gets together and say, or the manufacturers get together and saying, well, this is what we think advisors and their consumers actually need, and they standardize all that sort of information. And being part of that process, I know that very few advisors and very few end consumers were actually asked, what information do you need to make that informed choice, to make sure that you know, you're getting the information that you need? And what the most important point about all of these things is that the industry that we work in is all about financial returns. So the information, the data gathering, the presentation of that data is, do you want a growth portfolio? Do you want a total return portfolio? Do you want an income portfolio? And do you want it a little bit green, mostly green, or totally brown, or whatever? So how do you translate the information that the manufacturers are creating into non-financial returns? How do you as an advisor translate all that stuff that's not designed from first principles, but designed from, this is what the portfolio does, this is to get a financial return? And don't get me wrong, most clients want to do, want their money to do good, as long as it doesn't impact on their financial returns. So financial return is really, really important. But as part of the KYC, that know your customer, if the client says, yes, but I'd like my money to, help stop global warming, or make sure that no controversial or uncontroversial weapons where the money's actually going. So these questions, to getting from portfolio manager to advisor, is really, really difficult. And quite frankly, I don't think the consumer-facing disclosures help advisors that much to actually go through the suitability, that research sort of process, that due diligence, because due diligence for one client may be different for another client. And if you look at the target markets and the buckets that we put people in place, I don't think that the asset managers have got the right buckets for advisors' needs, unfortunately. Over to you, Ellie.
That was brilliant. Thank you very much to Frank. And thank you to all of you for sharing for a few minutes. That's brilliant. So I'm super keen to get as much information from all of you for our viewers as possible. So we'll now have some group questions. So I've got 3 targeted questions. I'd absolutely love it if each of you can answer them in turn. So for consistency, we'll follow the same order. So I'll ask a question, and then Sophie can answer first, and then followed by Lee, over to Frank after that. So starting with, how can advisors ensure that the due diligence they carry out can remain credible and future-proof against any regulatory tightening?
I guess that's me. So for us, when we, as I mentioned, kind of in that barometer report that we do, we talked about the Article 8 funds that we think show some signs of greenwashing. We also found we have a regulatory adherence assessment that we do, so lots of regulatory assessments. And with the regulatory adherence assessment, that's something we do as part of our in-depth due diligence, which is around 1,500 funds. And just over 10%, so 13% of the funds that we cover there, we flag for regulatory adherence. So that's to do with kind of consistency of language in marketing documents and what's in the regulatory documents, jargon, boilerplate language, and naming convention. So the naming convention one is the one that's flagged the most frequently. So around sort of half of that is naming convention. So while we expect that to reduce following kind of ESMA naming guidelines and the SDR, it was quite a significant portion of that, the funds that were flagging there. The most common issue obviously being kind of names like sustainable and impact, where we don't feel like it's been fully justified through the process, and the commitments maybe aren't high enough to warrant that kind of a name. The one thing I think that's really important, as we've all kind of talked to, and maybe I'm slightly biased in considering it's the bulk of what we do at Main Street, but that robust due diligence process is so incredibly important to be able to understand fully what a strategy is trying to achieve. My background is also kind of fund research more broadly, so we treat ESG and sustainability due diligence with the same thoroughness that we would do if we were doing kind of the full analysis as you would do sort of the financial and the fundamental aspects as well. So we have 80 factors that are in our model that we're delving into to understand that process. So I think while I'm not expecting advisors to necessarily go away and implement an 80-factor model, it's why people like us and people that engage in the ESG Accord as well are here to kind of work and be able to go into that detail to understand what a fund is trying to achieve, so that you can allocate to it comfortably knowing what you're actually getting in the fund.
Brilliant. It's a really good resource. Thank you, Sophie.
Yeah.
Okay, you, Lee.
Thanks, Ellie. I suppose for me, it all goes back to ensuring that the advisors are gathered enough and importantly relevant information on who the client is and what their needs and preferences and objectives are. So this information is then used obviously within the due diligence process to find the most suitable outcomes. And the advisor's job is to balance the attitude to risk and capacity for loss with those longer term objectives, which references back to what Frank was saying. Clients don't invest with the aim of losing money. They obviously invest with the aim of making money. It's how the path they take to making money, which advisors need to find out how the client wants to do it. So, I mean, that's sort of gathering that information's always been what advisors have done. But the SDR and investment labels, allied to, if you the financial life surveys from the FCA, all that indicates that there's high demand for, in broad terms, responsible investment, and the additional information which needs to be gathered around client preferences and objectives means that due diligence will have to be wider. Even if the overall due diligence process remains the same. So it's not about advisors changing the process. It's just broadening the scope of the process. And given that how broad the whole area of responsible investment is, from ESG through sustainable and onto ethical and values-based, the research part of the due diligence, it could seem daunting. So using Main Street, Green Gauge, ethical screening, eFund Eco Market, I mean, there are tools out there that will save advisors a great deal of time. And the key point here, I'm going to say it again, is documentation. So document how the information you've gathered on the client relates to the research you've done, and how that then relates to the suitability being delivered.
Brilliant. And Frank, over to you.
Yeah, I think, you know, the buzzword is horizon scanning, isn't it? So we know that SDR is a good start, but it's a start. It's not the finished sort of product, unfortunately. I know that people want to be able to implement a process and stick with it. But the problem with sustainability and responsible investing is it is forever changing. It's one of these sort of areas that, you know, we're going to see the UK introduce the sustainability reporting standards based on the ISSB. How does that impact portfolios? Will portfolio managers use those reporting standards to determine their investable universe? How will it affect their investment process? If the investment process changes, how do they communicate that to people who use funds? And if you're an MPS user, if you use model portfolios sort of services, then at what stage, where does your due diligence actually sort of start, and where does it end in terms of just the funds? Does it apply to the MPS? This complexity is not going to be able to provide good informed choice outcomes for clients, and contrary to sort of consumer duty. So if you are part of the sort of due diligence sort of process for an advice firm, then you have to put into place that regular reviews. You have to go long view. You have to be able to get your Google searches, your AI chatbots or whatever, to be able to sort of say what's coming down the pipe. How will that affect the advice process? And how will that affect the potential outcomes of what the information they are doing? And in short, it's all about the complexity that people are being bombarded with. And we have to find ways to be able to simplify all that different information, taking that data, changing it to information, and then from that information, getting wisdom and knowledge that you can apply to make sure that clients get the best outcomes.
Brilliant. Thank you, everybody. And we've got we've had a live question in, so I'll just, we will pick up if we've got time afterwards, but just want to let you know that we've got questions coming in. So, okay, next one. This is an interesting one, and I think important for highlighting change. What are the biggest gaps or weaknesses you see in how the industry approaches sustainability due diligence? Sophie?
So I think the biggest gap that we see is kind of a tick box mentality, this element of being like, okay, sustainability, great, I've got that, I've picked this fund, they sort of said to me that they were doing it, and I'm gonna fully trust that. But I think, kind of as Frank has touched on, like sustainability in particular is a constantly evolving space, and maybe more so as well than comparing it to sort of the more broader market. So I think treating ESG and sustainability as a compliance exercise alone, rather than recognizing that there is a thorough due diligence process that needs to be indulged, maybe, is quite a key component there, as like one of the biggest gaps that we see. So we think a great analyst will interrogate a fund's process to understand how it's delivering the sustainable outcomes, what the strategy is trying to achieve, and then we can expect that to continue going forwards. It's the same way that if you were looking at a growth fund or a value fund, you would be looking at the investment decisions that were being made. Are they aligned to what the fund is telling you it's going to do? So then when you're putting it into your portfolio of funds, you can say, well, I know that that fund is going to perform and balance this other fund that I've allocated to over here. So it's really, really important that people know what's actually in the fund and that they can expect that to remain part of the fund going forwards. So as I mentioned, this 80-factor model that we have at Main Street, we're digging in deep to kind of the research, what we're expecting to see. and making sure that also the asset manager, which is this first pillar that we look at, is creating an environment that allows this strategy to run effectively and to be supported. So kind of through commitment to sustainability, the reputation of the asset manager, their engagement and stewardship capabilities, and the resourcing that they have, as well as internal kind of data tools and platforms that are accessible to the asset managers, underlying fund managers. So that really great in-depth due diligence remains really important, and you do just have to kind of delve into the detail. But again, it's something that we do every day, and as as sort of the main thing that we're focused on.
Brilliant. And over to Lee.
Well, I'm going to answer this by going back a stage to the fact-finding part of the advice process. And now, when I say fact-finding, I don't mean the actual fact-find document, the physical thing, which is obviously full of loads of tick boxes and very specific questions. I'm talking about the broader fact-finding process, which is going to involve having a conversation with clients about who they are and what they want from their money. Rather than just sort of simply sitting there filling in a long form. And that's why things like ESG, sustainable, and values should never really be in the fact-find document. It's a bit weird to say, can I have your name? How much money have you got? Partners' names, kids' names, dog's name, how much money have you got? Do you want ESG? It doesn't fit. It's part of a separate conversation. So having that conversation with client, making them feel that the advisor is focused on their personal needs and objectives rather than feeling like they're, I don't know, in an advice machine. That's going to foster a much better client-advisor relationship, and asking what the client is interested in, what views they and their family have, and even asking them what feelings they have about what the future will bring. It's so client-centric. So regardless of whether the client has an epiphany moment, and says, "Oh, this sustainability thing, that's absolutely brilliant," or whether they just look at it and go, "Bit woke for me, no thank you very much." The point is that they will feel that they understand the options, they are making the choice, and then they're really asking the advisor to deliver the best outcomes for that choice. So that's where the due diligence then kicks in, but you still have to go back to asking every client what they want out of the process.
Brilliant. And over to Frank.
Thank you. I think there are loads of weaknesses that we can actually touch upon, but I think the main one for me is the whole process that the advisors go through at the moment is very much based on the financial. So, we call it capacity for loss rather than capacity for financial loss, because if you are interested in the environment, there are other losses that might be sort of important to you. When we look at risk profiling, most risk profilers are based on capital market assumptions, which is expected return and anticipated sort of volatility of that. There is that sustainability risk as well. It could be flooding, physical sort of climate change aspects of it. How do we incorporate all these sort of things into an advice process that the advisor feels happy that they're not going to get done by the regulator or their PI insurer or FOS, to make sure that they are showing, basically giving all the potential investment opportunities, investment sort of outcomes, if the client expresses some sort of values-based opinion to what they want to do with their money. So yeah, loads of weaknesses, but let's try and re-engineer a little bit a process that helps advisors give really good sustainable investing advice to their clients.
Brilliant. We do have another group question to do, but I'm very aware of time, that we were due to be finishing at 10:15. So I think that what I'd like to just say at this point is that this event is being recorded, so that everybody who has registered will get the live recording straight away afterwards. So I think that we should carry on, because these are really, really great topics. So we'll carry on, but if you do need to leave, great, but you can then dial in and watch the recording straight away afterwards. So our final question for the group questions here, as platforms, analytics and educational tools evolve, what does the future of advisor-led sustainability due diligence look like in the coming years? Sophie.
So I think it's that kind of empowerment through access to information. So access to better tools, clearer data, and more tailored education. So knowing exactly how to talk about these topics with confidence is kind of incredibly important. Right now, there's quite a significant knowledge gap between what the asset managers are saying, the advisors and the clients when it comes to sustainability, as we've kind of alluded to and touched on at various points during this webinar. I think while some advisors may already be specialists through having kind of a particular interest in this, many are still kind of building confidence in this space, and it's still kind of being deemed as something other to maybe what they see as core to their processes. So I think it's where kind of the people on this call and people that are involved in ESG and sustainability more broadly kind of come in. We're supposed to be helping bridge that gap, providing research and tools, and kind of giving the content that advisors need to have kind of more informed, better conversations with clients. I think particularly as platforms evolve, there should be kind of more intuitive, advisor-friendly interfaces that integrate sustainability as part of the process rather than necessarily seeing it as something separate. It's kind of one of those things that if you are opting in, then the information should be easily digestible. I think ultimately the goal is to make it as seamless and robust as fundamental analysis, and that people can feel confident that they understand all of the terminology as much as there is, or at least kind of are able to put things into buckets and understand kind of where things interlink and where things are completely different.
Brilliant. And Lee?
Well, there's no doubt that working smarter and more efficiently is the key. You've got regulatory requirements alongside pressure on fees, and we haven't got time to go into the fee debate. So don't get me started on that one. But what it means is that if advisors are going to grow their businesses and be more profitable, if that's not your aim, then really shouldn't be running a business, not a charity. The use of technology, it's the only way to manage the whole advice process. So if you're constantly looking to grow the business by adding more clients, all you're doing is increasing the regulatory burden, which sort of brings the loop back to you've got to be more efficient. And then you add sustainability and values-based into the mix, and there's no doubt that the workload is going to increase slightly. I say slightly because if the correct process is in place, and so an unashamed plug for our free to access suitability toolkit, wouldn't plug it if it wasn't free. So that's a process that can be implemented to demonstrate that clients are making an informed choice. So having the right process will simplify greatly. And I just want to make one reference to, I don't know if anybody's heard of this thing called AI. Now, speaking as someone, well, as Ellie knows, we use AI a lot, but we use it for very specific things. And of course, with AI, there's a big caveat, which is if you put rubbish in, you're going to get an exponentially larger pile of rubbish, steaming rubbish probably, out the other end. So AI will be helpful. You can probably use AI as part of the process, but I think realistically, using external support services, research services, which maybe incorporate AI, is going to be the way to go, because if you don't know what to put in, and you can't just put in a client's sustainability preferences without asking AI the right question, that's probably a job for other people. So don't see AI as a panacea, but AI will be used by other groups to help advisors reduce the regulatory and due diligence burden.
Brilliant. And over to Frank, please.
Well, I think I've had my thunder stolen by Lee, but no, absolutely. I think just sort of a few points on AI, the chatbots that are being used. So we're in a situation whereby it's so much cheaper nowadays, as of today, to use chatbots within the process. So if you can input your advisor process, either verbally or tapping in, if the system can actually do a lot of the heavy lifting for you, outputs a selection of, let's say, 3 sustainable sort of investments based on criteria that's been loaded up into the AI, and then outspits a sustainability report that you can sort of fit into your suitability letter, then that's something that AI can do. And whether you're a big firm or you're self-employed, 2-person firms, etc., the use of this technology, particularly AI, is going to make your life so much easier, because one, you're actually looking at the regulations. 2, you're looking at the full spectrum of investments available. And 3, you have the evidence that you can show a regulator, claims management company, FOS, whatever, that you've followed through the process. And this automation of the advice process is going to be driven by AI cheaply. Thank you.
Brilliant. Thank you all very much for this. It's really big stuff, isn't it? So I know that I'm not going to be the only one thinking that there's some really big takeaways. So with that in mind, I'd love to hear from each of you if you could give us one action point that advisors could take away with them today to strengthen their sustainability due diligence. So Sophie, first up with you, please.
So I've probably alluded to it, but learning the language. So I think knowing that ESG kind of at its purest form is risk management, and every fund manager should be doing it. And if they sort of say, oh no, that's something separate to me, then I'd be quite concerned. You should be having that as part of your process. Sustainability is about going further. It's something more. You're seeking positive outcomes for people or planet or whatever social outcome that maybe you have decided, or environmental. It's something additive rather than ESG it being at its basic. I think understanding that distinction is the main thing.
Yes, it is. Brilliant. And Lee?
Mine's going to be very simple. Ask every client. Go right back to what I said at the beginning. Ask every client, because if you don't ask every client what they want, even if 99% say no sustainability for me, thank you, then the due diligence process, no matter how good you think it is, no matter how comprehensive you think it is utterly pointless if you haven't got the right information to feed into it. So ask every client.
Brilliant. And Frank?
Evidence everything. I think that's the most important thing. Is if you're running a business, an advice firm, etc., what keeps you up at night, apart from being SMF, is making sure that you stay in business. Evidence everything that you've gone through is the biggest thing, I would say.
Brilliant. And shall we very quickly answer the question that we've got here? It is a good one. Where a fund meets ESG preferences, but the fund is accessed through a pension company that gives bad service, what takes priority? Who would like to take that one?
Do you want me to do it?
Yeah.
Yeah. Well, it'd be nice on a different planet if there was good service from manufacturers, but we're back on Earth, so there are bad instances from providers. I think in this particular example, all I can do is go back to informed choice and say, tell the client that in the advisor's opinion, the product, the investment that best matches the client's preferences and objectives in the sustainability space is this one. However, the company that provides it has really bad administration. So
yeah,
those two are facts. The advisor genuinely believes the fund is right, and the fact is there is poor admin. So with that information, the client can go, okay, but I'll put up with the admin. I really want that fund.
Yeah. It's being transparent upfront
That's
about
all.
the whole.
Yeah. Yeah, and then getting them to write to the pension company.
Yes, yeah, exactly. So we have apologies to all the viewers for running over. That was a very quick, I was going to say 45 minutes, but we've gone to 50 odd. I can't add that up fast enough in my head. But it is now time for us to close. Thanks so much to Louisa, Sophie, Frank and Lee for their brilliant insights, and thanks to all of you for joining us. Sustainability due diligence is evolving fast. I think it's fair to say that today's session has shown us all how those that are informed and act decisively will be the ones who lead in this space. We're all here to support you. Our contact details, Lee, can you share the slide? We're going to put them on screen now. We wish you all a great day ahead and a great good money week ahead too. There are loads of events lined up this week, including our Accord Talks podcast mini-series with episodes releasing tomorrow, Wednesday, Thursday and Friday. We've got over 20 amazing speakers on those 4 podcasts, including commentary from Louisa from the FCA on each of the podcasts. And finally, many of us will be attending the SRI Services annual Good Money Week event in person in London on Thursday. If you're attending as well, we hope to see you there. Please do come and say hello. So thanks again for joining us. Have a great day ahead. Thank you very much.